So how does a massive consumer goods company report almost 0% sales growth on paper, yet internally they are completely crushing their profit goals?
Yeah, it is kind of a fascinating paradox to open with.
Right. I mean, they're expanding their underlying business faster than they have in years. So today, we're doing a deep dive into the financial plumbing of Church and Dwight. And, if that corporate name doesn't immediately ring a bell for you listening, I can almost guarantee their products are sitting in your house right now.
Oh, almost certainly.
Yeah, we were talking about the powerhouse behind Arm & Hammer, OxyClean, Trojan, TheraBreath, and Hero Cosmetics. It's just this massive portfolio.
It really is. And in a volatile macroeconomic environment where, so many legacy brands are really struggling just to maintain their margins, this specific Q1 2026 earnings report is, well, it reveals a masterclass in how supposedly boring everyday items are engineered to generate massive sustainable cash flow.
I do have to mention, though, just to get to these numbers, the very first thing I encountered in our source material wasn't a revenue chart.
Oh, right, the verification screen.
Yes, it was this Cloudflare security verification screen demanding to know if I was a human. It felt a little bit like walking up to a very nerdy, exclusive nightclub.
Yeah, and the digital bouncer is standing there.
Exactly. A digital bouncer with a clipboard, making sure you aren't malicious before you're actually allowed to see the VIP data.
Which is funny, but I mean, think about it. That digital bouncer is protecting a highly valuable playbook.
That's true.
The financial data behind that verification screen is essentially a mirror held up to the physical and digital shopping carts of millions of consumers. So when we decode these numbers, we are essentially decoding how everyday people are making daily trade-offs in their households.
Well, let's jump straight into the biggest surprise of this report then, which is that gap between their top-line sales and their actual growth. Because looking at the raw numbers, their Q1 net sales were technically only up 0.2%.
Right, hitting $1.469 billion.
Yeah, $1.469 billion. So a casual glance might suggest the company is completely stalled, like they hit a wall.
It definitely looks that way on the surface.
But then you go one line down, and the report highlights that their organic sales grew by a massive 5.0%.
Which is huge.
It's completely smashing their own 3% outlook.
Oh!
And at the exact same time, their adjusted gross margin jumped 130 basis points to 46.4%.
I think we should probably translate that margin jump just because it is a really significant metric.
Yeah, please do.
So when they say a jump of 130 basis points, in plain English, that just means for every $100 of goods they sell, they are keeping an extra $1.30 in gross profit compared to last year.
Okay, wow. That adds up fast.
It really does.
Yeah.
Hitting a 46.4% gross margin on physical consumer packaged goods is incredibly robust. It just shows they are operating with immense efficiency.
That actually brings up a theory I had while I was reading through the section on their 2025 portfolio actions.
Oh. What's the theory?
Well, the report mentions this $400 million stranded cost drop that's tied to restructuring. And looking at it, it really doesn't look like they're accidentally losing money. Like, it looks highly intentional.
Right.
It's almost like they are a gardener who's aggressively pruning the dead or inefficient branches off a tree so the rest of it can grow that 5%.
That is a highly accurate way to visualize it, actually, because not all revenue is good revenue.
Right, that makes sense.
Sometimes a company acquires or holds on to product lines that generate top-line sales, sure, but those products drag down the overall profit margins.
Or they just drain operational resources, I guess.
Exactly. By divesting certain brands or restructuring, pruning the tree, like you said, they knowingly took a $400 million hit to their reported sales in 2025.
So they basically accepted the top-line revenue would look flat for a bit.
Precisely. They accepted it because the core portfolio that remains is just highly profitable and much easier to manage.
The branches left behind are producing better fruit.
Yes, exactly.
And what really stands out to me is how they are getting that fruit to grow. Because it's completely counterintuitive to the current market trend.
In what way?
Well, in the domestic consumer division, their organic growth was 5.4%. But if you look closely at the mechanics, domestic price and product mix were actually negative 0.1%.
Right.
The entire growth came from a 5.5% increase in pure volume.
You're hitting on the most crucial detail of their current strategy right there.
Yeah.
Because over the last few years, countless companies have relied on aggressive price hikes to drive revenue. I mean, they essentially asked consumers to pay 10 or 15% more for the exact same item just to cover inflation.
Oh, we've all felt that at the grocery store.
Absolutely. But Church & Dwight is taking a completely different path. They aren't padding their numbers through price gouging. Like you noted, they actually took a slight negative hit on price mix.
People are simply buying millions of additional units of their products.
Yes, the volume is doing all the heavy lifting.
Which is smart, building long-term brand loyalty by not punishing the consumer at the checkout aisle. It makes total sense.
Right.
But if sheer volume is driving this, we have to look at where all these heavy physical goods are actually going.
Right, the logistics of it.
Yeah, because the report highlights that global online sales now represent a staggering 24% of their total consumer sales.
Which is a massive chunk of the business.
It is. And meanwhile, their consumer international division grew 3.7% organically, and that was led by brands like TheraBreath, Hero, and Batiste. And they achieved that despite taking a hit with lower sales in the Middle East region.
Expanding their global footprint aggressively is definitely a big part of the volume equation. But I want to go back to that 24% e-commerce number because that is the metric that signals a really profound structural shift in how households operate today.
Yeah.
I mean, a quarter of their entire business is now digital.
I do have to challenge the logistics of that 24% figure, though.
Okay, how so?
Well, if we were talking about a tech company,
Yeah.
or, I don't know, a sneaker brand, I wouldn't blink. But Church & Dwight sells Arm & Hammer liquid laundry detergent. They sell massive, dense boxes of cat litter.
Very heavy items, yeah?
Exactly. The physical supply chain reality of shipping a 20-pound box of clay directly to a consumer's front door is brutal. The shipping margins have to be terrible.
Oh, they are.
Right. So how do they maintain that 46.4% profit margin while absorbing those crazy delivery costs?
It requires a master class in what we call portfolio averaging or basket economics.
Basket economics. Okay, break that down for me.
So you are entirely correct that shipping a heavy jug of OxiClean or dense cat litter directly to a home is margin crushing. On its own, that single transaction might barely break even.
Makes sense.
But Church & Dwight doesn't operate those brands in a vacuum. Over the last few years, they have strategically acquired lightweight, high-margin, incredibly trendy brands.
Oh, like Touchland hand sanitizers and Hero Cosmetics.
Yes, exactly. Think about the physical profile of a tiny box of Hero pimple patches.
It weighs practically nothing.
It weighs nothing. It costs pennies to manufacture. It costs almost nothing to ship, yet it commands a premium retail price. The profit margin on that lightweight cosmetic item is enormous.
Okay, wait, I see where you're going. The pimple patches are financially subsidizing the shipping costs of the cat litter.
In a macro corporate portfolio sense, yes. Absolutely. And they don't even need to be in the same physical shopping cart.
Yeah.
By blending the high-margin, lightweight digital native brands with the heavy, low-margin legacy items on their balance sheet, the overall e-commerce engine runs hot and remains highly profitable.
That is brilliant. They've essentially built a product mix that perfectly supports the medium it's being sold through.
Exactly.
Okay, that makes the acquisition spree make total sense. But, acquiring brands is really only half the battle. They still have to convince us to actually click add to cart. And according to CEO Rick Dierker in the report, their primary mechanism for doing that is relentless product innovation. I mean, he stated flat out that new product launches will account for half of their total organic growth in 2026.
Relying on newness for 50% of your organic growth is an aggressively high target.
50% is wild.
It is. It means you just cannot rest on your laurels. And when you analyze the specific innovations they highlight for this year, you see a very calculated manipulation of modern consumer psychology.
The product list in this report is genuinely fascinating. It reads like a psychological profile of the 2026 consumer.
It really does.
Let's look at the mechanisms behind a few of these, actually. First, TheraBreath launched a new toothpaste line that already has a 4.6-star rating.
Right.
Then you have Arm & Hammer Cat Litter launching Dual Defense with Microban antimicrobial protection.
Now that one is interesting. The addition of Microban is a direct appeal to the post-pandemic hyper-hygiene-conscious pet parent.
Oh, for sure.
They are taking a basic commodity like clay litter and engineering a medical-grade association into it just to justify brand loyalty.
That makes total sense. And then there's Hero Cosmetics. So they are launching facial cleansers mid-year, but the standout product is called Mighty Shield.
The liquid to patch one?
Yeah, it's liquid to patch invisible film for under makeup pimple protection. This just feels perfectly engineered for a selfie-obsessed culture where people want acne treatment, but absolutely refuse to compromise their makeup routine.
It solves a highly specific modern friction point.
Yes.
And by making it invisible and compatible with makeup, it shifts from being just a nighttime treatment to a 24-hour daily use product.
Which naturally drives up purchase frequency.
Exactly. You use more, you buy more.
Okay, then on the complete opposite end of the spectrum from high-tech invisible cosmetics, Arm & Hammer is launching a new value tier, baking soda fresh laundry detergent. And it's specifically marketed as having 10 times more baking soda.
A classic value play.
Right. And finally, my personal favorite piece of branding in the entire document. Trojan is launching the GOAT condoms.
The greatest of all Trojan.
Greatest of all Trojan. It features an ultra-flex, non-latex material and is already the #1 rated Trojan condom on Amazon with 4.7 stars.
The branding there is clearly aimed at capturing a younger demographic. But notice the emphasis on the Amazon rating there.
The 4.7 stars.
Yeah. In an environment where 24% of sales are online, a 4.7-star rating isn't just a point of pride, it literally dictates algorithmic placement.
Oh, right. Because it determines whether you show up on page 1 or page 5 of the search results.
Exactly. It's life or death for online sales.
Stepping back and looking at this entire list, though, it's so interesting. They're launching a strict value tier laundry detergent with extra baking soda for budget shoppers,
Yeah.
while simultaneously pushing highly engineered, premium invisible acne patches. It looks like they are intentionally playing both extremes of the market. I've heard this called a barbell strategy, capturing the highly budget-conscious shopper on one end of the barbell and the premium splurger on the other.
The barbell strategy is essential in a polarized economy, but what makes Church & Dwight's approach really unique is how they construct the weights on each end of that barbell.
How so?
Well, in the middle of the market, brands often get crushed because they aren't cheap enough to be a bargain and they aren't innovative enough to justify a splurge.
They're just kind of beige.
Right, and nobody wants beige when money is tight.
Definitely not.
So Church & Dwight uses their legacy trusted value brands like Arm & Hammer to act as the heavy, stable weight on the budget end. If inflation is squeezing your grocery bill, you trade down your premium detergent to the new Arm & Hammer value tier.
Right. You stick with a name you know but pay less.
Exactly. But human nature dictates that we still crave small luxuries, even in a tight economy.
Oh, the classic lipstick effect. Like, people might skip the luxury vacation, but they'll still buy the premium lip gloss just to feel good.
Exactly. Or the premium TheraBreath toothpaste, or the high-tech Hero Mighty Shield. They capture the consumer at both ends.
That's incredibly smart.
The value brands provide incredible revenue stability and massive operational volume, while the premium acquisitions drive cultural relevance, excitement, and those higher profit margins we discussed earlier.
Basically, they don't care which end of the barbell you are lifting as long as you are paying a membership to their gym.
That's a great way to put it.
But, managing this gym full of diverse brands is incredibly expensive. You mentioned they actively acquire these premium brands rather than trying to invent them in-house.
Yes, mostly.
And startups like Touchland and Hero don't come cheap, which brings us to the massive numbers sitting on their balance sheet.
The financial realities of rapid growth and aggressive acquisitions always leave a complex footprint.
Let's run through the costs of doing business then, because management explicitly called out several headwinds in the report.
Let's hear them.
First, their marketing budget rose to $139.4 million for the quarter. That's 9.5% of their sales, and they are actually targeting 11% long-term, which they call their evergreen model.
Right.
Then they're selling general and administrative expenses, or SG&A, which is essentially the overhead of running the corporate machine, increased significantly to $251 million.
That's a big jump.
It is. And the report notes this was largely driven by the Touchland acquisition, specifically citing $6.3 million in restricted stock charges plus amortization.
We should unpack those accounting terms because they tell a really fascinating story about how modern acquisitions work.
Yeah, please.
So amortization is simply the accounting practice of gradually writing off the cost of an intangible asset over time, like the brand value or the patents they acquired with Touchland.
Okay.
But the restricted stock charges are even more telling.
Really?
Yeah.
Because I just assumed restricted stock charges were just a standard corporate payout.
They are actually a vital mechanism of retention.
Oh,
Think about it. When a legacy giant buys a buzzy digital native brand like Touchland, they aren't just buying the chemical formula for hand sanitizer.
right.
They are buying the specific marketing genius and cultural intuition of the founders who made it cool on TikTok. If you just hand those founders a huge pile of cash, they might walk away the next day.
Oh, and take all that intuition with them.
Exactly. So restricted stock acts as golden handcuffs. It vests over several years, ensuring the talent that made the brand special stays in the building long enough to integrate it properly.
Wow.
It shows up as a major expense under SG&A, but it's really an investment in human capital.
You literally have to pay the cool kids to stay at the party.
Exactly.
That makes a ton of sense, but it still adds up. I mean, factoring in $31.9 million for capital expenditures this quarter, we have to look at the overall debt.
Let's look at it.
The company is carrying $2.2 billion in debt against $503.4 million in cash on hand.
Right.
Add in the macroeconomic headwinds, management warned about ongoing inflation, potential tariff costs, and transportation pressures, and it paints a slightly nervous picture. Are they risking overspending on these trendy startups just to buy future growth?
It is a dynamic analysts scrutinize very closely because a $2.2 billion debt load sounds really intimidating in isolation.
It really does.
But you have to contextualize it against their cash generation engine. Management expects to generate an astonishing $1.15 billion in cash from operations for the full year 2026.
Wait, so they're bringing in over $1 billion in pure operating cash in a single year?
Yes.
Oh, wow.
To put that in consumer terms,
Yeah.
if your annual take-home pay is $115,000 and your total mortgage is $220,000, you are in exceptionally strong financial shape.
Ah, okay. When you frame it like that, the debt is highly manageable.
Very manageable. And as for the macro headwinds like tariffs and transportation, management's thesis is that their relentless volume growth, combined with the pricing power of their barbell product mix, will just generate enough momentum to plow right through those external pressures.
Pulling all these threads together, I mean, the playbook Church and Dwight is executing is quietly brilliant.
It really is.
They proactively pruned $400 million in less efficient revenue just to create a healthier core. They're leaning heavily into pushing more physical volume rather than artificially padding their numbers with price hikes.
Yep.
They've engineered their e-commerce basket so that high-margin cosmetics subsidize heavy household goods. And they're using this dual-ended barbell strategy to cater to both the budget shopper and the premium buyer simultaneously.
And letting new product innovations do the heavy lifting for organic growth.
Exactly.
They haven't fought the reality of the 2026 economy. They have basically structured their entire corporate architecture to flow seamlessly around it.
Which is just incredible context to have. You know, the next time you are casually tossing a box of baking soda or a sleek little invisible acne patch into your digital shopping cart, you aren't just running an errand.
No, you're not.
You are an active participant in a carefully calibrated, high-margin corporate machine that blends logistics, psychology, and finance to stay profitable.
Every single unit you buy is a data point validating their model.
It's wild to think about. But there is one final, lingering detail embedded in this source material that I want to leave you with.
Okay, what is it?
Toward the end of the earnings report, Church and Dwight proudly highlights their ongoing sustainability progress. And they list an incredibly decorated string of accolades.
Like what?
They list Time Magazine's ranking of the world's most sustainable companies, Newsweek Magazine's America's Most Responsible Companies, USA Today's America's Climate Leaders, and the EPA's Safer Choice Partner of the Year.
Wow. Securing all of those is a massive public relations triumph for a manufacturer of their scale.
It absolutely is.
I know.
But here is the provocative thought to ponder. We spent a significant amount of time discussing how their global e-commerce has leapt to 24% of their total sales.
Right.
As that digital behavior continues to accelerate, we really have to ask, how long can any consumer goods giant truly maintain an America's Most Responsible Companies environmental rating while simultaneously increasing the massive, undeniable carbon footprint required to ship millions of individual plastic jugs of heavy liquid detergent and densely packed boxes of cat litter directly to millions of separate consumer doorsteps?
That is a really tough question. It is the ultimate modern paradox of convenience versus conservation.
It really is, and it might just be the next great challenge for that digital bouncer to figure out.